The first tick on the Nifty coming through with a cut of 130 points, not looking good.
Markets are injected with a fresh dose of geopolitical tension.
For the moment, it's Nifty, which is sitting with cuts of 130 points.
I think, 40 points still away from the day's low to where the Nifty is at right now.
150 points lower on the Sensex, on the Nifty. The Sensex has shed 470 points. The mid and the small cap universe has taken a bigger beating.
Hello and welcome to Markets Today. I'm Ekta Batra and here are the top headlines for this evening. At least 1,100 people are dead on the third day of the brutal escalation in the Israel-Palestine conflict. Global stock markets tread with caution amidst the turmoil in the Middle East. Sensex loses nearly 500 points and the Nifty loses over 140 points. Crude oil prices jump over 2% as tensions rise in the Middle East. Gold prices also soar as investors rush for safe haven options. Abu Dhabi Investment Authority, or ADIA, will invest almost 5,000 crores in Reliance Retail Ventures for a 0.59% stake at a valuation of nearly 8.4 lakh crore. The move follows recent investments by Qatar Investment Authority and KKR in the business. Tata Consultancy Services plans to consider another buyback offer at its upcoming board meet on the 11th of October. The buyback, the fifth by the company, is in line with the company's stated payout policy, say analysts. MCX jumps after SEBI permits it to shift to the new trading platform. Solar Industries gains on big orders from Coal India and GOCL Corporation ends lower despite order wins. Strong growth in sales lifts Prestige Estates. Hello and welcome to the show. Well, let's get to the first story then. Geopolitical tensions have rocked stock markets worldwide and India was no exception. The Sensex and the Nifty dropped 1% each and the broader markets underperformed. 43 out of 50 Nifty stocks ended lower. Prashant Nair is here with a wrap on how the markets performed.
Tragic developments over the weekend, and that had to have an impact on the market, and it did. I mean, the Nifty correcting sharply. We actually came to the lowest point of the day early on, right at start. There was a bit of a middling recovery for some time, but by close, that was sold into, and we ended within 20-25 points of the morning lows. Bank Nifty had it worse. That's the weaker of the two indices, has been for a while. And the Nifty Bank actually ending pretty much at the lows of last week, which is also where it meets an important trend line, slightly upward sloping trend line from the June lows. Mid-caps and small caps, well, they had it worse, 1.34% in the mid-cap index. The small cap index down about 1.7% as well. Large caps which lost, Adani Ports up on your screen, 5% down. HDFC Life, Hero MotoCorp were some of the others which came under selling pressure. There was also Mahindra & Mahindra and Tata Steel, which were down about 2% or a little bit more. In the broader market, of course, declines outnumbered advances by quite a bit. Lots of PSU banks is what you will see. Union Bank, IOB, UCO Bank, Central Bank. But there was also Godrej Industries, which gave back Friday's, sharp rally. There was JSW Infra, which is another port company. Recent listing has done very well, which gave back. There was Utkarsh Small Finance Bank, big rally recently, and GMR Airports, which was down about 2% as well. Some gainers as well. Oil India stood out. Of course, oil prices have spiked up. You have Quick Heal, Care Ratings, and PG Electroplast, which were higher. The question on everybody's mind is if this conflict continues, what is the impact on market? I went back and looked at the last two instances, both these conflicts in 2014 and 2021, and they will come up on your screen, ran for different durations, right? But this is the impact. U.S. equities in both these instances sold off between 4.5% and 5% or so, actually 5.6 there. The 10-year, which is basically an indication of risk on or risk off, came under selling pressure. They were down about 20 basis points on an average. Oil prices up 19% in the 2021 episode. And 2014, they were down 12%. But the backdrop to that is that prices were already at $120 per barrel. So, you were coming off of very high levels. And, of course, the equities where the conflict is happening, Israel, down sharply as well. The hope is things de-escalate quickly. Otherwise, the roadmap in terms of how markets have reacted in the past, of course, is with us. Back to you.
Okay, all right, Prashant, thanks very much for that. In fact, in market opinion, Ed Yardeni, president at Yardeni Research, says that India needs to be watchful for oil prices due to the Israel-Hamas conflict.
Well, India is a significant importer of oil, so much will depend on the price of oil. But as we've seen just recently, before this conflict started, the price of oil went up and then it came right back down. The demand is very sensitive to the price, and so we have seen that once you get up to $90, $95 a barrel, you do get demand destruction, which brings the price back down. So the risk is that this will become a much wider conflict, and that Iran's production will be impaired dramatically. But on the other hand, the Saudis would probably start to pump some more. So I think that, you know, the markets right now, the reaction isn't as bad as one would think.
All right, so that's in market opinion then. On to the second headline this evening. Crude prices have surged amid fears that the Israel-Palestine conflict could increase tensions in the Middle East and affect output from oil producers. Manisha Gupta is here with more details on this important development.
Oh, well, the crude oil prices, the first tick that we saw today in the morning was 5% on the higher side. Since then, it has been volatile moves coming in. And this is after we saw crude prices fall 8% in the previous week. The strength clearly comes in from the geopolitical concerns between Israel and Hamas there, and the expectation that this conflict could continue longer. Now, between Israel and Palestine, none of these are oil producers or oil refiners for that matter. But the point that this conflict is happening in Middle East, which is a third of where the crude oil comes in from, is what is concerning. There have been statements from Iran. We have seen US also send in warships at the region. So it doesn't look like that it is going to get done in the next 24 hours or a couple of days. And that's exactly the premium that the crude oil prices seem to be working with right now. On ground, there is no change on fundamentals. This is only the risk concerns that the markets are looking at, because on ground, we haven't seen any impact on crude supplies as of now. So this is all war premium that seems to be building up in case of the crude oil prices. Most banks and brokerages have quickly reiterated that they've been talking about 90s and even $100 a barrel of a possibility going forward. So that is one part of it. So while Middle East is one area, remember, one-fifth of crude oil passes via Strait of Hormuz. Now, and the economy around these areas in the Middle East is oil and gas. So if there are any concerns arising out of this area as well, that is what the crude prices seem to be weaving in case of prices. Most of the market will tell you that for the rest of 2023, including this and other various concerns on crude oil prices, it could be between $80 to $100 a barrel, a $20 of a range that you could see crude prices within for the rest of this year.
Okay, all right, Manisha, thanks very much for that. Let's also listen in to some opinion on how the escalating conflict could impact global markets.
Oil prices are clearly going to go up. They're going up now. This created a tremendous amount of instability, not just in the international markets, but it'll create some instability over here in our markets. Normally, when you have some instability in foreign markets such as the Middle East, it doesn't last very long in our domestic markets. Usually, we trade through it at a pretty decent pace. But we've the market's been trading at a pretty erratic downward trend over the past 4 to 6 weeks, and this sure doesn't help things. We thought, it looked like the market was going to firm up and hit a double bottom, but with this being thrown into the mix, I think that investors need to be a lot more cautious right now. This market could turn a little bit nasty for a short period of time. We're watching it. We were optimistic until, a day and a half to 3 days ago until this happened. So, we'll have to see what happens over the next, 2 to 3, 4 days.
Crude will hold on to its $3.50 or so premium, and I can see that building a little bit. And all of the market participants are going to watch Iran very closely. We're likely to see a major Israeli ground incursion into Gaza. And the question will be, if that gets going, will Hezbollah, which has about 130,000 rockets and could cause devastation in northern Israel, will they join this fight? If they do, then I think the crude risk premium is going to go much higher.
Okay, important opinion there, but staying with the story, Adani port slipped nearly 5% as the Israel war has raised concerns over the Haifa port. The company had acquired the port in northern Israel earlier this year for a total consideration of around $1.18 billion. In fact, all Adani Group stocks stumbled today and erased a market capitalization of over 30,000 crores. In a statement, Adani Ports said that they fully alert on Israel, but business continuity plan is ready. They also added that the overall contribution of the port to their total cargo volume is relatively small. Adani Port has also taken measures to ensure the safety of their employees. Well, in fact, Sun Pharma was also under pressure as its subsidiary Taro is based in Israel. We do learn from sources that there may be some impact on its production or sales in Israel, but no material impact is seen as of now. All right, let's get to the third story then. The third headline today, Reliance Industries closed almost 1% lower. Abu Dhabi Investment Authority plans to invest over 4,900 crores in Reliance Retail for less than 1% stake. The investment will then value the company at around 8,381 crores. Nisha Podar joins in with the details on this story.
Thanks for that. Yes, more investors joined the Reliance Retail's $100 billion club. In the latest, Abu Dhabi Investment Authority picks additional 0.5% stake for close to about 5,000 crore rupees to become the second investor with a follow-on investment in this company. So now their stake stands at 1.77%, one of the largest, remember, investors in Reliance Retail. KKR had also made a follow-on investment and owns 1.4% stake in Reliance Retail. Now, looking at the second round of fundraise at $100 billion valuation, which started just before its AGM in August this year, well, Reliance Retail has now raised about over 15,000 crore rupees by selling 1.8% stake in the company with investors like Qatar Investment Authority, QIA, KKR and ADIA, 3 investors. Now, Mukesh Ambani had also hinted at a strong global interest in his retail business in the last AGM, we remember, of Reliance Industries. Now, it comes after 3 years of the last fundraise at around $50 billion investment valuation, in which a slew of marquee global investors like Silver Lake, KKR, ADIA, GIC, TPG, the list is long, amongst others, had really pumped in over 47,000 crore rupees for 10.5% stake in the retail arm of this large conglomerate. Now, double the valuation comes on account of the scorching pace of growth of the company, as the chairman guided that retail will be the fastest growing business in terms of both revenues as well as EBITDA. So retail has multiple growth avenues. In the most recent developments, well, the brand bouquet has been expanded as it acquires majority ownership of Superdry IP for India, also getting ready for the big sale opportunities in the festive season. Well, JioMart rebranded its festive campaign to Jio Utsav, Celebrations of India, live this very weekend with MS Dhoni as the brand ambassador. JioMart's tie-up, remember, with Meta completes a year and has seen a 7x growth in the monthly orders via the WhatsApp business of that partnership. Now, in beauty products, it launched omni-channel beauty retail platform Tira, which opens its first Hyderabad store recently, taking the total store count to now 3 in India. Even to capture the iPhone frenzy and boost its mobile phone sales, well, the discounts offered for iPhone 15 purchased from Reliance retail stores. So more follow-on public investors really coming in as existing investors reinforce, because of the various growth drivers, its $100 billion valuation.
Okay, all right, Nisha, thanks very much for that. Moving on, let's take a look at the life insurance business data for the month of September. The industry has witnessed a 16% drop in premium on a yearly basis. However, private life insurance premium for the same month has grown 11% year on year. Yash is here with the details on this.
Well, Ekta, no doubt about it. It's been a weak month for life insurance companies. Premium dropping by about 16% in the month of September on a year-on-year basis. For the first half, also the premium is down about 13%. This is largely dragged down by the largest life insurance company, that is Life Insurance Corporation of India, or LIC, because if you see the private players' performance, that's relatively better. The September premium for private life insurance companies have grown by 11% in the month of September. First half, it's up about 14%. The retail AP for them is up about 12%. I spoke about the loser here, that is LIC. September premium is down 27% on a year-on-year basis. First half premium down 25%. September retail AP, that's seen a growth of about 5% on a year-on-year basis. HDFC Life, coming to the private players, has seen a premium growth of 8%. First half is about 15%. September retail AP has grown by 13%. ICICI Prudential Life, again, a very weak month for the company. September premium dropping by about 2.5%. First half premium down about 1%. September retail APE also dropping by about 5%. Max Life Insurance in the month of September posted the strongest set of data numbers. September premium grew by 24%. H1 premium was up 27%. Retail AP in the month of September also growing by 29%. SBI Life was the other strong candidate in the month of September. The premium in the month was up 16%. First half was up 24%. Finally, retail AP also grew by about 16%.
Okay, all right. Well, you are tracking more data, Yash, so apprise us of all the other data that is on your radar.
Well, contrary to the life insurance numbers, the general insurance numbers in the month of September looked strong, but that was largely driven by some of the unlisted general insurance companies. So September premium for the industry grew at 29%, first half grew at 15%. And look at the names which drove this strong premium growth in the month of September. Bajaj Allianz, SBI General, Tata AIG, National Insurance, as well as agriculture insurance. Standalone health insurance as a sector, that grew at 23% in the month of September. The first half premium was up about 25%. ICICI Lombard has been consistent with its growth rate. September premium growing at 13%, first half growing at 18%. Also market share growth of 24 basis points. New India Assurance, after a few weak months, it was some sort of revival in the month of September. So the premium in the month grew by 12%, first half grew by 8%. Market share, though, is still down by about 79 basis points. Finally, Star Health Insurance, the September premium, that grew by 15%. First half premium grew by 18%. Market share is up about 13 basis points. I spoke about the unlisted players. Just look at National Insurance. That grew its premium by 121% in the month of September. Bajaj grew its premium by 51%. SBI General as well growing its premium by about 31% in the month of September.
Okay, all right. So that's on the general insurance data. Thanks, Yash, very much for bringing us that comprehensive take. We need to take a short break, but stay tuned. We'll be back with all of the other top stories this evening. Welcome back. You're still tuned into Markets Today on CNBC-TV18. Well, on to the fourth headline today. TCS hit a 52-week high in early trade after the company announced a proposal for a share buyback. The company's board will consider the proposal during its meet on the 11th of October, which is later on this week. This will be the company's fifth share buyback in 6 years. Well, the earnings season will kickstart this week with the top IT companies. TCS is reporting its result on the 11th of October, followed by Infosys and HCL Tech on the 12th of October. Rima joins in to tell us what we can expect from the large tech companies in Q2.
Thanks so much for that. So the focus this time is going to be less on the actual numbers, but more on signs. Commentary, if the worst of the demand deterioration is behind the industry, if demand is picking up, are there green shoots? Can growth recover in the second half of FY24, or is it going to be only in FY25? Now, IT stocks have seen a very smart run-up in Q2. The Nifty IT index is up 7.5% in the July to September period versus the Nifty, which has rallied 1.5%. There has been this big outperformance, and it's been driven by two factors. One, strong deal win announcements, and two, expectations of a demand revival in FY25. Now, if you have to summarize Q2 is largely going to be a continuation of the weakness that we've seen. No further deterioration, but no improvement in outlook, but strong deal wins this time. So in terms of numbers, for Infosys, we're looking at a growth rate of 1%, constant currency quarter on quarter, similar to what they had last quarter. TCS at 0.7%. Wipro is likely to report a revenue decline for the third consecutive quarter, but still within its guidance. In terms of the other IT companies, it's Tech Mahindra, which is likely to be the other IT company apart from Wipro, where you could see a quarter-on-quarter dip in the top line. But the highlight of the quarter has been the deal wins. Deal wins have been very, very robust in Q2. So, for instance, Infosys had signed a very large deal with Liberty Global. For TCS, it was a large deal win with JLR. For HCL Tech, it was a deal with Verizon with over $2 billion in terms of size. Now, Kotak estimates that Infosys this time could report a total contract value of $5.5 to $6 billion, much higher than the average that we've seen in the last couple of quarters. According to Kotak, TCS could report deal wins of $12 billion this time, a jump of 48% on a year-on-year basis. The only question is, when it comes to these large deals, is are they going to be margin dilutive going ahead? For Q2, margins are going to be largely stable, as you can see over here. In terms of other factors to watch, guidance. Now, Infy's FY24 guidance stands at 1 to 3.5%, EBIT margins at 20 to 22%, likely to remain unchanged. HCL Tech had given a guidance of 6 to 8%, likely to be maintained, but they could guide for margins to be at the lower end of their guided band, maybe closer to 18 to 19%. TCS has announced that they will consider a buyback along with their numbers. And for Tech Mahindra, the focus is going to be on the strategy under the new CEO and the margin recovery. And finally, on valuations. Valuations are similar to the 5-year average, but they're slightly lower than what if you compare it to the 3-year average, because the 3-year average takes into account the post-COVID boom. Only in the case of Tech Mahindra have we seen valuations higher than the recent past, and that's on expectations of a re-rating, a turnaround under the new CEO.
Okay, all right, Reema. Thanks very much for that. So a lot of the IT companies do come out with numbers this week. Moving on, the fifth headline today, a CNBC-TV18 News break confirmed MCX has received approval from SEBI's tech panel to go live on the new platform. The stock gained nearly 2% on the back of the news. Sudarshan, who's been tracking the story from the start, joins in with more.
What we told you first is now confirmed. MCX has received an approval from SEBI's technical advisory panel to go live on new software platform. And in the latest update, we understand from sources that MCX will submit October 16 as go live date of the new platform. Now let's talk about how the new platform will impact costs. As per analysts, this shift to new platform will reduce the cost of software platform to 10 to 12% of total sales from current levels of nearly 100%. MCX currently pays rupees 125 crore per quarter to use the platform of 63 moves. It is a jump of 7 times that company used to pay at the beginning of last fiscal, that is FY23. Earlier on September 28, MCX had announced of shifting to new platform from October 3, but that proposal was asked to be kept in abeyance by SEBI on September 29. It was because of Chennai Financials and Market Accountability, which is known as CFMA, had filed petition before Madras High Court raising technical issue at the new platform. And that case is now likely to be heard in the High Court on November 29. In the meantime, SEBI's technical advisory panel has decided to give the shift a go-ahead after going through submissions by MCX with regard to the complaint by CFMA.
Okay, all right, Sudarshan, thanks very much for that. So MCX was one of the stocks which was higher today. Moving on, Solar Industries gained on the back of a huge order win boost from Coal India to supply bulk explosives, while GeoCL Corporation slumped close to 2% despite orders worth over 750 crores that the company won. Upasna is here to take us through the details.
Well, Solar Industries and GeoCL is the stock that remains in focus today on the back of the order win. First up, let's talk about Solar Industries. It has backed a significant order worth rupees 1,853 from Coal India for a period of 2 years for the supply of bulk explosives. Talking about the company's total order book as of Q1 FY24, it stood at 2,678 crores, which includes the defense order book of nearly 1,000 crores. The company's current order book after the order win has lifted up to nearly 4,500 crores, and in Q1 FY21, the company backed total revenues worth 1,682 crores and has clocked highest ever defense revenues, that is 155 crores, with a growth of nearly 141% on year-on-year basis. The company has also given an annual guidance of defense revenue for FY24, that is around 700 crores, lifting the defense revenue run rate per quarter from 155 at current level to nearly 175 crores. The company expects the defense revenue run rate to pick up Q3 FY24 onwards. Now next up, moving to GeoCL, the IDL Explosives, the wholly owned subsidiary of the company, has bagged orders worth 766 crores, again from Coal India for a supply of bulk explosives over a period of 2 years. The company has a healthy order book at 551 crore level for the next 2 years.
Okay, all right, Upasana, thanks very much for that. Prestige Estates gained 1.5% after reporting a strong second quarter business update. The company has recorded pre-sales of over 7,000 crores, which is a 102% increase as compared to the same quarter last year. Sunil Bhutra is here with the details on this.
Thank you so much for that. Yes, it was a very strong update, 102% increase in their pre-sales. They've seen collections going up by 1% as well, and sales volumes are up 50%, and all of it has come in at a higher price as well. So it was a mix of both price and volume rise for the company, where their price increased by 29% on a YOY basis. However, the management said that they expect prices to stabilize from here on, and they do not see any further tick up. In the first half, their pre-sales are up 70%, collections are up 13%, volumes are up 30%, and realizations are up 25% as well. The first half has seen record sales for the company, and it is almost equal to FY23 sales. So FY23 they did sales of 12,900 crore rupees. In the first half they've done sales of 11,000 crore rupees. The company said that 5 projects were launched in Q2, which aided to the bookings that they saw this time. 2 projects were launched in Hyderabad, 3 in Bengaluru, and Bengaluru projects were the ones which contributed around 5,000 crore plus of quarterly sales this time around. In fact, the management said that these are the projects which will continue to aid, and they will actually surpass their FY24 sales guidance as well. Interestingly, I was also reading a Nuvama note which was on Bengaluru real estate, and it continues to be very bullish. It says housing demand continues to be robust. Developers have shifted to new launches and executions. Approval related issues have also been resolved, so that's a big takeaway. Business development activities picking up as unsold inventories are very low, and land capex will be funded via internal accruals.
Okay, all right, Sunil, thanks very much for that. On that note, it's also a wrap on this edition of Markets Today. Stay tuned for more news and updates.